So now I'd like to talk about a couple of examples, real-life examples from our corporate governance group. The first example involves a North American retailer. It had a market cap of around 200 million, and Dimensional owned or held on behalf of its portfolio companies about 4% of the outstanding voting stock. That's a meaningful amount. Now, at the time, the company faced a proxy contest. Well, what's a proxy contest? In general, when a company puts up potential candidates for its board, the management nominates these candidates. Shareholders can nominate their own candidates, but they have to do so typically through a proxy contest. It's a fairly expensive exercise, but at times, if management isn't doing a good job, shareholders believe it's worth doing that. And so essentially, it becomes a political campaign where shareholders are asked to vote for one candidate or another candidate, and one candidate, if it's the incumbent, will lose their job. So you can imagine that the incumbents are highly incentivized to win the vote of shareholders. And in practice, that's fine. In this particular case, we found out that management was paying brokers to secure votes on their behalf. Not just votes, but votes for the incumbents. In essence, taking shareholder money and spending it in trying to preserve their own seats, which was clearly a conflict of interest. And so we believe that. We did speak with the company and voiced our opinion. And we can't say that this is actually what influenced the ultimate outcome, but we do know that after we talked with them, they did announce that 6 of its board members who were being challenged would step down, including the chairman. And in our view, given the practice of using shareholder money in a very self-interested way, is something that we did not want to continue. We're certainly happy that the existing management at the time is no longer going to be continuing on the board. The second example involves a bit of a larger company. This was a US-based theme park and entertainment company. Now in this case, the chairman had served as the interim CEO for a period of time. Part of his compensation was based on performance, about 60,000 restricted shares that would vest upon the attainment of certain goals. Those goals were not met. However, the compensation committee decided it was still fit to go ahead and vest those restricted shares for the chairman, which was clearly, in our view, poor practice. These performance-based shares are performance-based for a reason. So we voted against that vote and also against all the members of the compensation committee. As a result, the board chair did not receive majority support and will step down at the end of this year. So in conclusion, our philosophy is that stronger governance practices will be reflected in higher returns. That shareholders do need to be heard, and so we do seek to increase shareholder value by enhancing governance at our portfolio companies, but we do so also taking into account the potential costs and benefits in terms of what we do from voting. Thank you again for the opportunity to share our corporate governance practices with you.